Hey everyone, welcome back to FinTalks. Today we're diving into a hot question. Will the US fall into a recession in 2026? With growing economic uncertainty, rising debt, and shifting global trade, many economists are sounding the alarm. But what do the data and forecasts actually say? Let's unpack it. To understand recession risk, we have to look at where things stand right now. Here's the picture. Slowing growth. According to EY, U.S. GDP growth is expected to slow to 1.4% in 2026. EY elevated recession risk. Economists surveyed by Bankrate put the probability of a recession by March 2026 at 36%, which is a significant jump from recent years' Bankrate inflation and tariffs. Trade tensions, especially around tariffs, are creating supply-side shocks, which many analysts say could weigh heavily on growth. Economic Research .bnpparibas.com. Credit cycle stress. Credit conditions are fragile. According to S&P Global, the economy is facing uncertainty from slowing demand, immigration shifts, and shrinking labor force participation. So, what do major institutions and banks think? JP Morgan. They now see considerable downside risk through 2026. While recession isn't a certainty, they estimate around a 40% probability of recession in the medium term. JP Morgan Chase Goldman Sachs. They recently raised their 12-month recession probability to 35%, citing slowing growth, weak confidence, and tariff risks. Investopedia +1 UBS. This is one of the more aggressive calls. They interpret hard data signals, jobs, production, credit, as suggesting a high risk of a downturn. Some of their recession risk metrics are at historically worrying levels. The Economic Times BNP Paribas. According to them, there's approximately 25% probability of a full-blown recession, but their base case is marked slowdown, not necessarily a deep contraction. Let's dig into some of the biggest risks that could push the U.S. into a recession by 2026. Tariff uncertainty. Persistent trade tensions can choke supply chains, raise costs, and reduce business investment. Debt stress. High levels of federal debt and large fiscal deficits could limit the government's ability to stimulate the economy if a slowdown hits. Labor market weakening. Some forecasts suggest job growth could soften and unemployment may inch up. Credit market risk. Tight credit conditions, especially if combined with rising yields or defaults, could strain businesses and consumers. Stagflation risk. There's a worry among some that we could face soggy growth with persistent inflation, a dangerous mix. UBS has even pointed this out. So what does this mean for you, as an investor, a saver, or just someone watching the economy? Be prepared. With a 25 to 40% chance of a slowdown, it's smart to make sure your personal finances are resilient. Emergency fund, diversified investments, low-cost debt. Watch key indicators. Keep an eye on unemployment data, credit spreads, and inflation trends. These could signal whether a downturn is becoming more likely. Investment strategy. You might lean toward more defensive assets, high-quality bonds, or less rate-sensitive equities if you think risk is rising. Stay informed but not panicked. Economics is not destiny. Forecasts are probabilistic. There is risk, but there's also room for policy, innovation, and resilience to change. So, will the U.S. go into a recession in 2026? The short answer, maybe. The odds are elevated, but it's far from a sure thing. Several big institutions see real risk, but many also expect a slowdown rather than a collapse. If you found this breakdown useful, hit that like button, subscribe for more economics and personal finance videos, and let me know in the comments. Do you think a U.S. recession is likely in 2026? Why or why not? Thanks for watching. I'll see you in the next one. The Narrative.